Your lender isn't going to determine how much you can afford to pay on your mortgage. They're going to determine the amount you could qualify for, and the amount you qualify for is not the amount you can afford. So before you start shopping around for a home or mortgage, you need to take a closer look at your current and future spending. Create a monthly budget for now and the possible future. It is up to you, and you need to determine how much you could afford to pay. How do you do this? Well, start by reviewing your credit card and bank statements for the past several months. I recommend printing 2 to 3 months of statements and going line by line, adding up how much you're spending. Create a list that accurately reflects your spending. Put your expenses into categories and put them into budget tools like this one from the CFPB or this one from Freddie Mac. Link to these tools will be in the description of this video. Remember, and this is very important, remember to budget for things like maintenance, repairs, and utilities like gas, electric, water, internet. These expenses can vary depending on where you live, based on local utility rates, your home size, climate, and how energy efficient the property is. When it comes to the maintenance and the repairs, one rule of thumb that I use is allocate at least 1% of your home's value a year going towards regular maintenance or any repairs that could pop up. So if the value of your home is $400,000, plan on spending around $4,000 a year to maintain that property. And again, depending on where you live and lots of other factors, that amount of maintenance and repairs can vary. But planning for 1% is a good start. Once you have created a current budget, start thinking how your budget might change over time. How will it change once you've bought your home? Will you need to start saving more each month for emergencies or funding other goals like a family vacation or paying for college? Will you be up for a promotion or possible pay raise? Will you be starting or adding to your family and need to cover the cost of childcare or make career changes to accommodate your family's needs in the future? Add up all the expenses for your current and future budget. Compare your current expenses to your monthly take-home pay. That's after taxes, the amount of your paycheck that's being deposited into your checking account each month. How much is left over? If the amount you typically have left over in your bank account each month doesn't match your budget, re-examine your expenses and budget. What you should have left over is what you can currently afford on your mortgage. Now that you've determined how much you can comfortably afford on your mortgage today, review what you expect your expenses to be in the future along with your income. How much room will you have left over for your mortgage payment in the future? Did it increase or decrease? Buying a home is a long-term investment. Make sure the mortgage payment you afford today is one that you could afford in the future. Now that you've determined how much you can afford on your mortgage, let's look at the key factors that impact your affordability, like your debt to income ratio, your credit score, down payment, and income. One of the things lenders look for when determining your affordability is your debt to income ratio, or what we call DTI. This is simply a comparison of how much debt you have compared to how much income you make. Lenders want to make sure you're not spending too much of your income on debt payments, including your new mortgage. A common rule of thumb is that your mortgage payment should not exceed 30 to 40% of your gross monthly income. And your total debt payments like car loans, credit card bills shouldn't exceed 40 to 45% of your total gross income. Keeping your DTI ratios low will help you qualify for better terms when it comes to getting a mortgage. A higher income typically means you could afford a more expensive home, but your debts can reduce that. Also, your credit score is going to affect the interest rate you get on your mortgage. In the Mortgage Basics 101 video, we talked about how the interest rate can impact your mortgage payment. A higher credit score means a lower interest rate, which means you can afford more house for the same payment. Now, let's talk about how to estimate your monthly payment. You can use a calculator to get an idea of how much you will be paying on your mortgage. Remember, your payment will include principal and interest, taxes, and insurance, PITI. By entering your estimated home price, down payment, and interest rate, you can calculate your monthly payment. Just make sure the payment fits in comfortably into your budget and you're considering all of your other expenses. Mortgage calculators, while they're not perfect, they are a handy tool that lets you determine how much house you can afford without talking to a lender. It's important to be realistic with how much you can truly afford. While it's tempting to stretch your budget to get that dream home, remember you'll still have other expenses like maintenance, utilities, and everyday living costs. In the First Time Homebuyer Mistakes to Avoid video, we talked about the importance of sticking to your budget. It's great to aim high, but you don't want to be house poor, where all your money is going towards your mortgage and you have nothing left for savings or emergencies. Choose a home that comfortably fits within your means and you'll enjoy it a lot more. And if you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C. And the purpose of this channel is to help you manage your mortgage and finance your real estate goals. And if you found this video helpful, check out some of my other videos. Check them out. you might find them helpful.